All right, welcome to a new episode of Financially Speaking with SFM. I'm Dan LaForest. I'm one of the wealth advisors here at Security Financial Management. And I know that a lot of people are really concerned about what's going on in Israel and Russia with the Ukraine war. And there's so much geopolitical pressure out there that a lot of people are worried about markets. And I got a great guest today. Paul Peterson, the Regional Vice President from First Trust, is going to join us. And we're going to talk about the history of the market when we are looking at conflicts around the world, geopolitical pressures, and try to make a little bit of sense of why it's important to understand that environment. All right, Paul, we were talking about the conflicts in Israel, the conflicts with Russia and the Ukraine. But, a lot of people are a little bit nervous when they start hearing about geopolitical pressures and investing. And we get calls all the time from clients wondering whether or not it should affect their strategies and whatnot.
Yeah, Dan, certainly our thoughts and prayers go out to people in the Middle East right now suffering from a really bad attack and things that are happening. Unfortunately, in the United States and around the world, we've seen wars before. One of the things about the marketplace, that's our job to discuss. People can buy and sell things. But at the end of the day, the market's affected by long-term vision planning, population growth, inflation, and companies that can withstand crises. I think about the day-to-day consumer that brushes their teeth. Nobody's going to stop brushing their teeth tomorrow just because of the conflict overseas. Nobody's going to stop taking their heart medicine if they have a heart condition because of something happening. So the marketplace itself is determined on earnings over time, and earnings are reflected of interest rates, of population growth, and of course inflation over time. And unfortunately, short-term aspects can impact, but usually that's what happens over the long term.
Paul, a lot of people are asking questions about this, but the reality is we've been here before. Even though it seems to be fresh, we have been through different cycles, whether it be Vietnam in the 70s and the Cold War with Russia in the 80s. And then you get into Afghanistan in the 90s and 2000s. But we've seen this type of thing. And, I think it's important to really put things in perspective. Isn't that right?
I think so. At the end of the day, we have volatility every year. I think about the day-to-day changes in the market. We average 10% correction every year. We average 120 to 30% correction every 3 to 4 years. And unfortunately, that's just part of it. The market has a tendency to overreact on the downside and the upside. And wars and conflicts are some of those. And we as investors look at it and say, hey, this good company is trading down in value. The fundamentals haven't changed. So the old aspect of buy low and sell high, your objective is to buy when everybody is selling, when people are panicking, and then sell when everything's euphoric in nature. But our firm's in the camp of buy good quality companies when they're trading below, and over time, we're going to make good money in them.
Paul, one of the things that I enjoy having conversations with you is let's look at the data. Let's take a look at hard facts, whether, it doesn't matter what topic that we're looking at, how could it affect the markets? We have to look at data, and you presented some really good data, and let's put some of that up today. And it kind of shows through the war times and how the stock market has reacted.
This is a great chart to show. It goes back to 1928. It shows every conflict we've ever had. And over time, like I said earlier, the market has averaged 8 to 10%. And ask yourself, well, why does it average 8 to 10%? And it has to do with company earnings. It has to do, again, with population growth. Think about the last 100 years. The population in the United States has been about 2 to 2.5%. Yeah, last year it was a little lighter, but in the world, that's in essence what you have. And then on top of it, over the last 100 years, inflation has averaged right around 3.7 to 3.8. So you combine those, you generate a 6 to 8% return just if you're a company that benefits from that. I think about the toilet paper business. I think about the toothpaste business. I think about if I needed a tractor and I'm a farmer, or I think if I needed medicine, all of those things, if more people in the world consume them, sales are going to go up, earnings are going to go up, revenues are going to go up, dividends are going to go up. And you can see the bumps along the road. I mean, if you drew us kind of a straight line, in the middle of that, you can see the market gets overvalued sometimes, and then you see those bumps in the road where it gets undervalued. But over time, it's about earnings and revenue and the things that we talked about.
I think this is kind of a cool chart too, because it takes us all the way back into 1928, all the way up to current day, and it's showing the number of conflicts. The Spanish Civil War in 1936, all the way through the Russian-Ukraine conflict in 2022. So you can see that there is volatility, but over time, and it gets a little crazy when we're investors, because we tend to take a look at what's happening in front of us instead of understanding how it could possibly play out. And I know you've got a little bit more data, and we can get into this. The U.S. stock market returns after major geopolitical shocks.
Yeah, you can see the one-day return, right, when something gets announced. And we all remember, just a year and a half ago when Russia invaded Ukraine, the market actually that day went up because people were worried about it. But you can see the 1 year return later on average is positive. But look at the maximum drawdown. I mean, I think we all can remember, when 9/11 hit. I think I was 28 years old. I remember exactly where I was, when it's standing. The stock market closed down for 3 days. But what you'll notice is it took 30 days to recover off of losing 11% in that max drawdown in a short period. So, these are short-term aspects of it. Obviously, we don't want to dismiss what's happening. But again, our job is, where do we make the most money with the least amount of risk? And sometimes fear and emotions drive things rather than the actual fundamental data. So this is a great chart that shows that.
And then you've got U.S. stock market returns during major wars.
Yeah, I mean, you can see this again. It's similar. What's interesting, in World War II, we averaged 21% a year, and the orange bar is just the volatility of it. We all know what happened in the Iraq War, as that's been the most recent, the Gulf War. But over time, again, you end up making money because we spend money as a country and individuals. So it doesn't change your behavior. Again, what reflects stock prices over time are company earnings, and companies will figure out a way to make money in any environment we go through.
And then staying the course. I think, going back to the last slide, one thing that was consistent there is every one of those particular wars, there was a positive return.
Yeah, this is probably my favorite chart, because every year, I mean, you could have the best economic period of time, nothing happens in the world, and you're still going to end up with probably a 5 to 10% correction in the year. I mean, you could have the greatest economy in the world and volatility is there. So this just shows you on the top bar, it shows you calendar year returns and what the market actually generated in a return. And on the bottom, it shows the volatility that year, intra-year, from peak to trough. So this year, we just entered a 10% drawdown as of Friday. Of course, the market's rallying a little bit today, but expect, I always think this, if we all have money coming in each month, we want a dollar cost average in it. The last day of the month, I hope the market's down so I can add in and buy or lower. And over time, I know things will work out.
Buy more shares, right?
it's amazing, right? Buy low, sell high. I mean, again, the business long term will make money based on the things that we talked about earlier.
So at the end of the day, I think the lesson always continues is especially if you're dollar cost averaging, and what for a lot of people to understand is if you're still saving for retirement, don't get more conservative with your portfolios. You're putting money in on a periodic basis. Every 2 weeks, you get that paycheck. You're putting money in. If you're a retiree, I think it comes back to is understand your risk tolerance, because how you invest your portfolio over the long term, what we try to do is help them understand what those guardrails look like. Well, what if the market goes down? Well, let's position your portfolio so it only goes down this much, but also understand that on the upside, you're going to be very, there's going to be a limit on how much growth you can have. But, Paul, again, thank you for joining us today, because I think this is good information. And if anybody wants more information, or information like this, First Trust does a great job of getting us information, data, if you will, and it can be shared with our clients. Just give me or any of the other advisors that are called at Security Financial Management. But Paul, I appreciate you joining us today. This is Financially Speaking with SFM, and we'll see you here soon.
Thank you.